George of the jungle, strong as he can be.
For cripe's sake, dear George, why are those closing costs so high? As some of my clients from the Midwest would affectionately ask the first time they're seeing a loan estimate. So that's what we're going to be discussing in the creditjungle.com today. This is George Anderson. Thanks for coming in. And what I want to do in this video is I want to go through a loan estimate. And a loan estimate breaks down the closing costs into two categories. And there's just two very broad categories into which all the charges fit. And the easiest way I know how to explain it is that some charges are one-time non-recurring fees, like your lender fees, your title fees, your appraisal fee. Those are fees you pay once and once only. And then you have recurring fees, which are technically categorized into what we would call prepaids. Those are items that get paid monthly or annually. Can you think of what those might be? So you have property taxes paid annually. In the state of Utah, at least, some states it's on different intervals. You have homeowners insurance that is paid annually, and you have interest that is paid monthly. So I'm going to pull up a loan estimate here, and this is on an FHA purchase, a $400,000 FHA purchase. And we're just going to go through the categories on here so that you can see what's going on. And you'll see that in section A there, you have your origination charges. So for myself, these are the lender fees. So the lender fees are the $895 processing fee and an $895 underwriting fee. And those go where they say they go. The $895 goes for underwriting, closing, doc prep, everything else. And the processing is the fee that comes into my branch and becomes part of the commission on that. So the next thing you have on there is section B, and it says services you can't shop for. He goes, what do you mean? You mean I don't have choice in that? Well, yeah, you cannot pick the appraiser that you want to use. You could have your next door neighbor, your brother who's an appraiser, but you cannot use him. We have to have a random selection process with an appraisal management company. You cannot choose which credit bureau you want to use. We get to use all three, and our scoring model, which is used for the mortgage industry. We've talked about that before. And on this particular case, this is an FHA loan, and there is a one-time or upfront mortgage insurance premium that is 1 3/4% of the base loan amount. In this case, that's $386,000 or $6,755. Now, because that is considered a cost, it goes down and it rolls down into the bottom line with the title fees, so that your closing costs appear to be over $10,000. But $6,700 of that is a fee that is paid to the Federal Housing Administration. And it is not coming out of the buyer's pocket. It's not coming out of the seller's pocket. It is financed or added back into the loan. So you're making a payment on that. You're borrowing that money, in essence, from HUD and then making a payment on that. But if you take that out of there, the closing costs on this loan, in other words, your one-time non-recurring fees on this loan, are about 1% of the loan amount. So that's fairly modest on that. And then if we go on to section E over in the right-hand column, now we come into these other prepaid items, and we also have government recording fees, which is going to be what Salt Lake County would charge. I think it's $90 or $91, or $89, but we just put it at $90 because I can overstate a fee, but I can't understate it. If I understate it, I'm stuck with it. I have to commit to that. And then we've got these prepaid. So you have your homeowners insurance. You pay the first year's premium, $65 a month times 12 months is $780. And then you have interest from the day that you close. So this contract has a closing date on the 25th of the month, and there'd be 5 days left in the month. So you would be paying forward $175 of interest at the time of closing, but the first mortgage payment on this loan in particular, closing June 25th of 2020, will be August 1st. So by the time that August payment comes due, you're actually paying for July's interest on there. But at closing, you're only paying 5 days or the remaining month's prorated interest based on how much interest it costs per day. And then you have other money that goes into the escrow account. So section G, initial escrow account payment at closing. So this is based on having a first payment of August at this point. So there's going to be 3 months at $65 a month collected. So that during the course of the year, enough money will be collected to pay that insurance premium when it comes due next year on its anniversary. And then the property taxes here, it's showing that we're collecting 10 months. Now, I don't want to spend a lot of time on this, but because this is a purchase transaction, the seller is going to be giving at closing a credit for the amount of time that they were in that property. To the day, it'll be prorated. So if this loan closed at the last day of June, that would mean that the seller is going to be giving the buyer a credit for 6 months at the time of closing. So the buyer's net cost out of the pocket is going to be 4 months of mortgage insurance, or only $900. So that's another $1,350 there that's going to be paid by the seller at closing. And the same thing with Section H, if you look down at that one. So owner's title insurance policy, that's also paid by the seller. Now, why is it being shown on the loan estimate? And people ask, well, why is it my cost? No, it's not yours. It is a cost. Your real estate purchase contract is going to delineate who pays these costs. If your contract negotiated for the seller to pay all of your costs, then all of these costs are being paid by the seller. The one exception is that the seller is not going to pay the mortgage insurance premium to FHA. So people look at this $15,910 closing cost figure, and of course they think that, well, George, you told me that the closing costs were going to be about $6,000. I said, yep, I did. So you got to figure in the credits here is that you've got FHA, you're being financed $6,700, subtract that. Then you have to subtract the owner's policy of title insurance, another $1,700. Then you're taking away another $1,350. So you're reducing that by about $6,000. So you take about, you take about $10,000 away from what the seller's credits are and what's being financed in the loan, and you're left with about $6,000. And that's what we tell people when we're figuring it out. So again, the loan estimate shows what all the costs are, but it doesn't necessarily explain who is paying those costs. You have to refer to your real estate contract. And every real estate contract, even if you don't ask for the seller to pay the buyer's closing costs, the Utah real estate purchase contract defaults in having the seller pay their portion of property taxes for the months and days that they own that home into the current year, and they also pay for the owner's policy of title insurance. So that's a big chunk of those closing costs there. $3,000 on this particular example, that's going to be a credit from the seller. So anyway, hope that helps a little bit. And these are the types of things that I like to do with my clients, is help them understand the process, how it works. And if you look at how it nets out down there, your buyer is basically coming in with their 3.5% down or their $14,000 down payment. So I hope that's helpful for you. I would love to meet with you and answer any questions that you have. Thanks for dropping into thecreditjungle.com today. This is George Anderson. You can push button, get mortgage professional, and I hope you have a great day, and we'll see you soon.